Good afternoon, welcome to Chicago Future of Finance. I'm Oliver Renick down at the Cboe floor here in Chicago, and things are going pretty smoothly. A little bit of rotation is maybe the name of the game here. Some January effect, potential small cap leadership. We got Nvidia down. We've also got chips overall getting hit, but a few other rays of hope for speculative activity and MicroStrategy, which is back firming up a little bit. Crypto is also hanging on into the mix right now. Market overall looking fairly firm here. This is the chart for IWM. I want to start there because generally speaking, the small caps have been looking pretty good, pushing to fresh new records here. That's definitely what you want to see if you're looking for some participation outside of the S&P 500. Now, over the past year, the IWM and the small caps were pretty much in line with the rest of the market, so things have been moving up fairly smoothly, but there could be a message to read if there's real rotation away from semiconductors. A bit of a sell-off today in semis with Nvidia down, but obviously you're still looking at big numbers in the last year for these stocks. Nvidia still up 32%, and within the general range it's been in between 190 and 170 for probably 2/3 of the trading period over the last, call it 7 months or so. It's just generally been a reliable chart. If Nvidia slips further below, past 170, then maybe I get a little bit worried. I'm also watching the 10-year yield very carefully. We talked about this with Scott Bauer yesterday. We're going to revisit it again today. Very clear line in the sand at 4.2%. Economic data maybe taking front and center stage as the main driving force for markets with jobs tomorrow. And keep in mind also that we got some pretty good data already. Yesterday it was ISM services hitting well into the mid-50 range. That's pretty nice. The other thing was today we had two numbers that are worth attention. One of them is the productivity and the jobless claims. Jobless claims hitting basically in line with expectations. Productivity doing a little bit better, hitting at 4.9%. Probably a message there about the overall AI impact and the health of the economy. Productivity up 4.9% with unit labor costs down 2%. If you remember that chart people were putting out about the S&P 500 versus jobs and the invention of ChatGPT, there's a big break in between the two. Well, this is the potential reason for why capital markets could still be booming, even if there's not as robust of a job market, because AI is now increasing productivity, allowing people to find new ways to contribute. So that's going to be the challenge, is whether or not you're investing in AI to keep up with it or using AI in some way. But I think it's really starting to show up in some of these figures. So tomorrow's event for the employment report is indeed, I think, a pretty important one that you don't want to sleep on, given the chart for the 10-year yield and the fact that we could potentially get a little bit of a breakout if it gets past 4.2%. I think that would be pretty fun. I think that would be pretty interesting. So that's my main theme. The other thing I would point out too is just the life that's shown up. It's small, it's marginal, but at least it's something for MicroStrategy. One of the biggest stories of the last 6 months, just the massive sell-off that was going on in Master, even when Bitcoin was solid, and then eventually Bitcoin joining a MicroStrategy to the downside and underperforming last year. The fact that you have both these assets now fairly range bound. Here's the box I drew on Bitcoin yesterday, which looks like it's pretty cozy underneath 100, but above 85. You got to take steps before you can leap. We know Bitcoin likes to leap. Let's see if it can get back and maybe test above 100. That's why yesterday I put the risk radar yellow light onto Bitcoin off from red, which I had had for much of last year. So it's pretty much a good situation, I think, here with stocks green, gold still looking green despite a little bit of chop, and looking for answers pretty much everywhere else in the market. Guy who's pretty good at helping us find answers is Mr. Brent Kochuba of SpotGamma, joining me here this afternoon. Brent, you've been talking about the potential for rotation. It kind of looks like we're getting some more of that here today. The fact that the market's not falling apart and VIX is calm with some of our key tech players, memory stocks, Nvidia down 2-3%. What does that tell you?
Yesterday was a big, in really the last few days, a big bid into some of these memory names in particular. You look at SanDisk and Micron. AVA is another one mentioned by NVIDIA. And so those names were up. If you look at just the last week, they were up anywhere between 20 and 40%. and the implied vols and those things are really screaming. And so there's some correction now in those names. Overbought conditions, I would say, rather than necessarily kind of a big sell-off. And related to this is this idea that correlation, which we've been staring at, has been driving lower. Now, some of that is we do have some Mag 7 earnings coming up in another month, but there are absolutely these pockets, we call it vectors of attack or pockets of volatility where traders are focused on bidding up stuff that had previously not been focused on all that much. And so not only do we see that in these memory names, but interesting, Oliver, if you look at call skew in something like a Caterpillar or Home Depot or Costco, there's a lot of these names that are catching a bid, or at least people are buying a lot of calls in those types of names as well. So that speaks to something of the, not IWM specifically, but just the idea of rotation, right? And Dow kind of chugging along. So there is absolutely this rotation. And again, the $1 million question is this just a natural end of year, start of year cycle, or does this have to do something more with what's happening in the economy? You mentioned good jobs report. I think it's the lowest number of job openings we had since COVID started, if I have that correctly. Now, tomorrow, NFP, there is a fair amount of vol priced for NFP tomorrow on a relative basis. Today's straddle was a very lightly priced 40 basis points, meaning that it was only pricing in 40 bips of movement in the S&P for today. Tomorrow is a little bit higher. We're a little bit more like 60 bips to 80 bips. And not only is that for NFP, but there's also the Supreme Court tariff ruling. And I'm not going to pretend to know exactly how that could impact the market, but that is absolutely something that traders are watching.
I also think just after the past year, if you tried to be the smartest guy in the room on tariffs, bad strategy. You know what I mean? That was my approach back in the spring. I think it served pretty well, was that, look, if everybody thinks there's a certain number for like the average level and it comes above, maybe the market doesn't like that, but ultimately trading on AI, trading on options flows, all have been more indicative. Brent, you hit a bunch of good stuff for us there. I just want to highlight a few of them. One is the slight creep up in VIX, but still pretty low at 15. The other one that you mentioned was not like a troublesome sell-off, more like an oversold sell-off, maybe in names like Micron. Here's the chart from Micron. We do see that it was overbought, rather, so just correcting from overbought, of course, not oversold. The thing's been an absolute beast. And then the other one you mentioned brought me back to a little bit of my Bloomberg days of some of the labels for the market and seasonality conversation. The January effect. That is typically a small cap rotation. I just pulled it up here to make sure I was right on that. And yeah, particularly small cap stocks, post tax loss selling, January, early Q1 is oftentimes good for the Russell.
Yeah. So to the point earlier is this just that type of rotation, tax loss selling, January effect, et cetera, or is this sort of the start of a big rally for 2026? Sorry, I forgot the year. So, I think the thing you could flag here that is obvious is some of these names were just very overbought. And the vols now, the short-term implied vols, are getting squeezed down to a lower bound. And so on this topic of kind of overbought condition, we are watching the fact that if you break 6,900, we could have a decent correction. And quite frankly, I think people may want to see a correction because if you missed buying a lot of these names that are ripping like a Micron, then maybe some contraction would do you good, right? Google doing very well today, but Apple doing very weak as an example, and Nvidia down. So again, this is so far just a rotation. It's a dance amongst the equity or a dance inside the equity space as opposed to saying, let's go get some bonds or step out of the equity realm. So I think there's a lot of perceived safety in the equity space, but I do think that overall I would just characterize that as kind of overbought when I'm looking at single stock vols.
Good point. Apple, by the way, to your point, now oversold. Overbought in January, which, by the way, when we talked about it on the show, December, that was such a key sign that markets were going to hold firm when Apple was making highs. Now that Apple's getting oversold, maybe worth watching to see what happens there in the coming days. Good eyes on that. Yesterday, you told us about Core 1M. The volatility in single stocks versus the rest of the index. So to your point, maybe some of these things just have to normalize a little bit, and maybe we just have to shuffle the deck up, for kind of a fresh deal rather than really change the overall trajectory and trend of things, which has been so positive.
Yeah, that's right. And I think what happens is the short-term, short-dated implied vols are getting really quite squeezed, right? Those are the ones that are really quite low. And so what you're seeing is short-dated implied vols are very low, and then 1 month vol to the point of the VIX being at 15, half to 16 is fairly elevated, right? And that is because there is a lot of stuff happening at the end of the month in terms of big mega cap earnings, FOMC, et cetera. And so, there is this little bit of sort of, we can party while the sun is shining here, and that sun is going to be shining, I think, for another week or two. And then all of a sudden we got to start worrying about, the potential macro catalyst of FOMC and some of these other things. The other thing I would just mention is I don't know, for example, what the tariff headlines could be or what that has anything to do on the macro front, but it's that type of like weird curveball, and it won't take much to kind of cause what I would call like a volatility spasm where we just get that resetting, the reshuffling of the deck, right? That's kind of what happened in mid-October. We keep talking about that time frame where, okay, correlations reset a little bit, vols sort of reshape or sync back up. And I think that, that is kind of the risk for the market right now, right? Things are very calm. People are debating which stocks they own. They're certainly rolling into names that gone up 40% in a couple of days, right? So, there's a little bit of bullish froth, I think, that could stand a bit of a correction. And ultimately, I think that would be healthy for the longer term.
Well said. I think also the idea of shuffling the deck fits with my crypto comments over the last 24 hours. The shift to yellow from red on my risk radar for crypto because Master's firmed up, because Bitcoin is holding in. If we're going to get some monster risk-off move, those are still always susceptible. So the fact that they're firming just kind of suggests more of a rotation thing, I think, to your point. What about with the metals, which obviously have been in kind of a world of their own? We were looking yesterday on SpotGamma. I'm pulled up right now on your tape with some of the really heavy amount of options slinging going on in SLV. It seems like it's still up here.
Yeah.
900,000 options volume today.
Yeah, the vol is still quite high, and I was doing a little bit of background checking and seeing that the ETF now, the option size and the position size is now getting pretty large relative to the commodity. So the idea that the silver ETF could be kind of wagging the dog a little bit, I think, is becoming a little bit more real. And if you look at how people are positioned, that implied vol is very rich. Calls are very rich. It's hard to buy calls in this type of chop and expect them to have a payoff, right? And so you start to have a problem where silver needs that incremental buyer that's interested in buying calls at incrementally higher, not just prices in terms of the SLV asset or silver asset, but also vols, right? It's stock up, vol up. And so we're seeing SLV in particular struggle with that 70 level, and we're kind of chopping and grinding, and I think that's number one, burning off or going to burn off some of that extra implied vol here. But it's ultimately a real test of sustainability here for silver. I do think silver got a little shot in the arm with the Venezuela situation, and it's kind of just a flight to non-dollar assets, if that makes sense at all, with Bitcoin and gold kind of catching an immediate bid off of that. But silver, I think, is under has a risk of a decent correction here. Just because, again, that implied vol is getting heavy and the name is unable to really kind of, make a move higher here. And so that could really lean on things. Just under that, though, you have MicroStrategy. To your point, again, all of a sudden this name is back in vogue for a moment. We'll see how long that sustains for. But that Bitcoin space suddenly is coming back to life a little bit. Just a week ago, people were saying Bitcoin was dead, right? Or 2 weeks ago. So, it's funny how this works, that the rotation sort of breathes life into things. But ultimately, again, you highlighted before, if we have risk off, these things are not sort of necessarily going to be a safe haven if we get some sort of an asset related or a rates related move.
That is a good point to be aware of, especially with silver that has more of a speculative higher beta angle to it. I do think gold has proven itself to hold up in a lot of different environments over the last few years. And it's hard to put a valuation on gold. It's not like we can say, oh, these things are expensive, right? Kind of like the same argument with Bitcoin. Oh, well, what's the value of it? But I will say that obviously after a big move in sort of anomalistic style move, gold futures up 67%. Probably fair to say it's more on the expensive end of its own valuation. So if we do get risk off, maybe be aware. But I'll say, Brent, I got to see it to believe it. For silver, you could tell me, and I buy that a lot easier, that, okay, if there's a sell-off, silver's likely get hit because it had just much more of that kind of meme style, kind of newcomer joining in the party a little bit later, whereas gold, just over the last 4 or 5 years, has survived so much and been stable either as an outperformer, as just a sideways mover during periods of weakness. It got hit when the Fed hiked rates in 2022. But that was about it. So
Yeah.
I got to see gold really weaken before I do anything to kind of change my view of it, basically. But silver, I think, is more vulnerable.
Yeah, and again, my statements of too rich or too cheap is based on looking at the options, implied vols compared to that of the last year or so. And so the other thing to note here is that this is not just a silver and gold trade. You got copper and other metals too are just surging. And so, there's the kind of macro, debasement trade, I guess, in some ways, nuclear related, going up as well. So, there is, of course, that whole just tailwind. So you have just money pouring into those asset classes, the materials type assets. And if you look at XME or XLB, for example, those ETFs, which are based on the stocks related to, say, metals and mining and things like that, they're also breaking out, as are defense stocks right now. So, that's a chart that, looks pretty good to me, Oliver. And, these things are breaking out for reasons, right? It's a longer term trend. But again, overbought conditions in the short term don't speak to necessarily a break of the longer term trend.
ITA, one of the defense aerospace ETFs, up 55% in the last year. Pretty wicked candle on there today.
Yep. XLV is another one.
Healthcare yesterday had a really good day, but a little bit of a pullback. So some little chop, but overall, really good stuff. You mentioned XME too, which is just a really beautiful chart. The way this has been holding right above the high from September. Brent, before I let you go, give me the index level analysis here for tomorrow. I'm kind of glued into the 10-year tomorrow at 4.2% to see if a good jobs number can finally push us above through there. What are you looking at in terms of the stock index? What do your gamma analysis and SpotGamma data tell us?
6890. We've been watching 6900, specifically 6890. If we lose that level, then I think the vols sort of reset themselves. That correlation trade kind of comes in, the unwinding of correlation comes into play a little bit. So I think we could have a pretty sharp, quick correction if we lose that 68.90 level. I'm not talking about a 5 to 10% drawdown in equity markets, just something in the order of a 1, 2, 3% correction, I think, could be underway if we lose that 68.90 SPX level.
Okay, 68.90. Obviously, I think we'd like to see a 7 handle. I don't know if it's going to happen tomorrow, but maybe next week, Brent, if jobs doesn't throw things out of whack.
Yeah, and you can make the case that we pull it back a little bit, right? Build some vol, and then we can get more momentum to the upside. Right now, things are just very stalled out. There are some call sellers above, and so that's just sort of sitting on things. There's really not much catalyst or spark for movement at the moment. And so in the absence of some type of new technology or major new macro development, if we can build vol up a little bit and then sell that vol, then that can help to boost equities to that 7,000 level.
Yeah, indeed. Nice. Always good stuff. Love it. Brent Kochuba, SpotGamma, the man. Thank you very much, sir.
Thanks,
We're going to take a short break, 2 minutes. Then we're coming back with Mr. Pete Najarian. We're going to take a look at some of the options trades that are catching his attention. A few of the items we just hit there. We're going to talk a little sports too, some drama in the coaching realm for NFL. Also Bears dropping off the list for the Super Bowl odds. Be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection. Seeking to deliver more than 70% of the upside, and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, welcome back to the show here. We got stocks still holding on pretty good as the S&P 500 just minimally changed on the day, about 6 points. VIX very tightly bound below 16, but a little bit of a steady creep. Mr. Pete Najarian in the mix today from Market Rebellion. Pete, good afternoon. Volatility is still pretty subdued.
Yeah, it's great to see you, man. You're looking fantastic as always down there on the floor. I love it.
It's not too busy, but there's some nice life down here. You can feel that, as Brent and I put it, the market's kind of shuffled the deck a little bit. A couple different leaders have popped out, but overall it seems like we're smooth sailing still.
Yeah, it feels pretty comfortable, especially when you're looking at that volatility index that we were just talking about. I mean, it's been in this very tight range, and it doesn't seem to want to break too much over that. Call it 14.5 to 15.5, but you know, if you stretch it out a little bit further, yeah, it's a little bit larger than that, but not much. I mean, we have been in this for a while now. Well, I guess the big question is, at what point in time do we see one of those sparks again that actually kicks us back up towards 20, 25, maybe 30? So that, I think, is something that we're kind of at least keeping an eye out for that. But so far, so good as far as smooth sailing. January kicking off pretty daggone strong, I'd say.
Volatility still cheap, mean a good time to put on wagers and bets. I know one group you've been watching are the financials and the banks.
Yes.
We were talking about Goldman Sachs at 940, just an incredible looking chart with IWM looking good today. I'm thinking maybe regionals, KRE, Pete, got any love for the little guys?
I do. We see a lot of option activity in there. We've seen KRE. We've seen some call buying in a KRE, and some of it pretty good size call buying. Not so much today or yesterday, but we have seen that as we've gotten here into 2026. Interesting to see that. Obviously, earnings season kicks off, and next Tuesday we'll start to see some of the big boys really bringing up some of the different things that are out there. JP Morgan, Bank of New York, some of those are coming up. Bank of America, Wells Fargo, Citi on Wednesday. Thursday we kick it off with Goldman Sachs and Morgan Stanley and BlackRock. So it's going to be a busy week next week, and I think that the financials are up for the challenge. I think that when you look at what they've been able to accomplish over the last year, it's been fantastic. I don't think it's over, though. To be honest with you, Oliver, I think these financials still have plenty of juice to go even further along. A lot of that having to do with IPOs, a lot of it having to do with just how well they're doing on the investment bank side. And that, I think, is something that's going to be very, very important. If that continues to be strong, I think that these names still have plenty of upside.
I got to say, I think this is one of them. It's been for years now since the great regional bank kerfuffle. The great regional bank panic. Some of it, that was a fun time, right? It kind of was like we stared into the abyss, Heck, I was at Schwab at the time too, so it was interesting to see how that kind of rippled through the whole financial system, the way we had to, figure out how we're measuring exposure and leverage to all kinds of things, basic things like bonds. So it was kind of this moment where you had a peek into what many had described as a risk, and ultimately, it turned out to be something that we managed, and was isolated. But I still think that means that group carries a certain indicative kind of panache, where when they are breaking out, that looks like risk on to me.
Right. Absolutely. I'm right there with you. And I'll tell you what, it's been magnificent to watch more than anything. How about Goldman Sachs? I mean, it really has been an incredible run that it's been on.
Almost $1,000.
Yeah, not so bad, right? I mean, and I still am a big fan, and you know this because I talked about it, I think, last week, was, looking at some of the stocks that I really like, I look in that financial world. Citi is another one of those names, and it's been absolutely on a great tear itself to the upside. Look at that. I mean, it looks very much like Goldman Sachs did, right? It's been on this run, and it still remains, when you talk about book value and what we're looking at here, this is another one of those where is it stretched? No, it still has plenty of room, I think, to the upside. So Citi and these investment banks, I think they're all going to be solid, but Citi probably from where they stand right now, which is just basically, price to book is one. The rest of them are closer to 2.5 and 3. I would say Citi still has plenty of juice to go even higher.
Yeah, good eyes on those. I mean, really consistent looking charts, outperforming the market by multiples over the last year. Not something you see, into weak economic situations, really,
Right.
especially when you throw KRE in there along with the rest of the big boys. Active capital markets, of course, as well, does not hurt at all. All the stuff going on here does not hurt at all.
Right.
Pete, when we think about how it connects into potential rotation, do you think it's worth then, taking any money out of the tech stuff, any of the memory plays? Like is the run in Micron over? I guess that's the test here. Is this just a kind of brief moment, or do we need to be wary if we're going to be positive on banks leading? Do we need to be wary about the other stuff?
Well, no is my answer because I think
Okay.
so many people at the end of 2025, the last couple of months, they were talking about, wow, the bubble's going to burst for the AI. I don't know where they're looking, but I'm not seeing that happen. Matter of fact, I'm seeing even more strength coming towards a lot of the world of AI. And as you just mentioned, Micron, that was one of those that actually came in and because of earnings saved the markets to some degree, especially the AI related markets. So, I look at somebody like this memory world and Micron, it's up 163% in the last 6 months. You know what the PE is right now? The forward PE of Micron. Is it 60? Is it 80? Is it 100? No, it's 11.
It's all, yeah, it's a consistently cheap one, even after a big run.
Right. And then even take a look at Western Digital. Yes, it's higher. It's at a 26 PE. It's up 184%. SanDisk is up 600% over the last 6 months. All of these are over the last 6 months. It's a 26 PE. So, Oliver, when I look at this and I hear people talking about, well, this is overvalued, sure, there are names that are part of the AI world that are absolutely untouchable, in my opinion. But when you look at some of those that are involved in the memory space and you look at those PEs, I wouldn't call that very stretched at all. As a matter of fact, I would say that they still have plenty of different, room in front of them, and the demand for data centers, the infrastructure that goes along with AI. There's a lot to this part of the memory side, and I don't think that they are anywhere near the end of this run. I think there's still plenty of room, and if the demand is there, which Micron did say, hey, we can't keep up with demand, well, that tells me that these stocks have a lot more room to the upside still.
Boy, the Western Digital chart is just like a nosebleed doozy of a chart. I will say that. Left for dead. That's what happens when you start getting priced for I don't know, falling so far behind. And then all of a sudden, you're in the mix. So
Right.
that I think also is just astounding. We talked, John and I, about Intel a little bit yesterday. And that stock's come back too. So, a little bit of give back there, but I do see a line on that chart for Intel at about $45 that might be kind of tricky to get through for the time being. But overall, I mean, this seems like, Pete, we are still in an environment where you just got to figure out what you want to be in and go for it, basically, because I just don't see a lot of macro risk. What about tomorrow if there's some kind of shocker in the jobs? Because I see the 10-year. It's sitting at 4.2%. It's tested it over and over and over again. I don't think it's a bad thing at all if we get through there for the right reasons. But what do you think we should be looking for in the economy and any potential risks for tomorrow?
Well, I think that obviously the obvious answer would be we're finally going to start getting more clarity, right, to what's really going on and where we stand. And I think on top of all of that, we still have to look even a little bit further, down the road. It's not that far, but who's going to replace Powell? I mean, I think we've got some good names that are out there, and people are kicking around who this guy's a lock, that guy's a lock. But I think it's really, really interesting where we stand right now. Is the economy as strong and potentially as strong as that we keep hearing about? And I think the answer is probably yes. I mean, everywhere I go, just like you, Oliver, I mean, when I go out, do I go to restaurants and see how busy they are? Absolutely. I think if you go across what's going on within the economy, there is good spend that remains to be out there. And I think because of that and other reasons that are out there, the economy is still kind of humming along. Now, if it stumbles, and if that's a possibility, of course, but if we stumble, now what kind of a pullback are we going to get? And if so, I think we're going to see that volatility that you and I were just talking about. That would be something that really could give this the volatility kind of that breakout sign where maybe we get up towards 17, 18, maybe even close to 20 if people get pretty nervous. But for right now, I don't see that, but it's a possibility, and I don't want to look past that. So certainly, could VIX start to get to a next level? It certainly could.
Yeah, but you got to have a reason for it,
Yep.
And tomorrow, I know these are not big numbers we're expecting, right? I'm gonna pull it up right now. It's not like we're expecting the roof to blow off for jobs, but considering kind of where some of the fears were originally, these numbers are in the right direction. They're positive, looking for 55,000, slight drop off from last time, but the no big surge in unemployment, looking for 4.6 to stay the same. I would also just bring up to your point about looking around to see signs of AI slowing, and there not being many. Productivity and cost today. Cost down, productivity up. What else do you need to hear to believe in this story? Right?
I'm right there with you, Oliver. I mean, that is the story. And you know what? If we believe what the earnings have given us over the last quarter, and I think we do, obviously, when I look at, Micron capping it all off, they did talk about exactly that. And this is, I think, a great example of that, right? I mean, the fact that, hey, they see demand continuing to grow, and I would imagine that they can maybe have a little bit of room on the pricing. So I look at the markets as reasonably strong right now, if not totally strong right now. There's always something somewhere hidden that could happen, but as of right now, I haven't seen where it is, and I have no idea. But I think the reality is we're in a stronger economy than people want to sometimes embrace.
I think so too. You got reasons why some folks kind of want to frame it one way or the other sometimes,
Yep.
Axes to grind, if you will. But
Sure.
ultimately, I look around and it looks quite stable. It looks quite solid. A lot of people thought that once we started getting these numbers back in after being, out of commission for a little bit with the government shutdown, that it was going to print a bunch of negative figures. That was the
Right.
bear case, remember? Like
Yeah.
Q4 or 3Q last year, Q3, Q4, September, October, whatever, right? 40 plus days of shutdown. People were telling a real dire story about what it was going to look like when we started back up, and I'm just not seeing it.
Yeah, it's not that dire, is it?
It's not. It's not.
The idea of the perma bear comes to mind for me because we see so much of that, Oliver, and a lot of it on TV and different media sources and so forth. But I think that the reality is, you know what? I always like to call it boots on the ground. When you go out, when you're doing this, when you're doing that, when you're traveling, what does it look like? And I'll tell you what, it still remains bullish from my perspective. But I know that those perma bears that are out there, they still want to fight against it. And you know what? Those are the guys that I'd like to trade against too.
Yeah. I will say now, yesterday I titled the show Stocks Unstoppable. So people were, saying, well, that's the top. But, I've got a backup plan, Pete, because they put it in Aldi. You guys, you're in the Midwest. You got an Aldi.
I know
around.
Aldi's. Yeah. Love them.
So usually I hit the Whole Foods downstairs, but I popped into the Aldi yesterday, and I don't know what's going on in that place. It's somewhere between like Costco and a garage sale. But if and when the recession hits, that place is going to be packed.
I'll tell you,
I went in for one item. I
love
couldn't
it.
stop grabbing stuff off the shelf. It was like $2.99, $3.99. I don't know the brands, but I'm
The deals
there.
are there. Yeah, you know that they're brothers, right? That the Aldi and Trader Joe, those two guys are brothers.
Makes sense. No, it had that feel a little bit. Yeah.
Yep, it very, very similar feel for sure. And you know what? They give it to you at a reasonable price. How they do that, I don't know all the details behind
That's
that
what I'm
side.
saying.
But
It's like Costco meets like, open house. I don't know. It was like they were unpacking the boxes. It was just kind of like a free for all. I don't know what their plan is there. Let's switch gears. Let's get a little risky.
Uh-oh. I love that.
All right, so in the world of football, Pete, a few developments since we last spoke. Our Bears dropped off pretty hard from the list, number one. I think right now they're sub 3% on Kalshi for making an appearance in the big game. What do you think?
Yeah, I think I'd have to go with that, to be honest with you. And especially in the NFC right now, when you look at who are some of the top teams, it's not Chicago. Their top team, but they aren't the very top. The very top still has to be Seattle. They look fantastic. The LA Rams, who are going all the way across the country over to Carolina.
Yep. Kalshi's got Seattle as number one.
Yep, they're good. LA's good. So, I like the Bears, but the Bears, let's be honest, the Bears, they lost to Green Bay when Green Bay had Jordan Love at quarterback. They beat Green Bay when they didn't have Jordan Love at quarterback. So Jordan Love's going to be there this time. That makes it a little bit tougher for the Bears. That doesn't mean they can't get out of the first round, and I think that they could. But I think when you look down the road, I think that it's either going to be Seattle or the Rams. I just feel like they're stronger and better, and probably even better than Philadelphia and some of those that at the beginning of the year, it was going to be Philadelphia. I'm not so sure that they're going to make it through. I think they beat the 49ers, but only because the 49ers defense is just, they basically have an IR, everybody there is on IR right now, and that's a problem for their defense.
Pete, the other big story, Ravens coach John Harbaugh out. Question is where he's going to go. I do have some visual support for that one. Miami right now at 33%. And then New York Giants also at about a 3% chance. So it seems like the market's kind of so on this. What do you think? You got strong feelings?
I do. I think he wants to have the kind of team that he's had, because he's been with Baltimore until now, 18 years, and he's been to the Super Bowl. He's been to the offseason. I think he's one of the best coaches in all of football, quite honestly. And matter of fact, the only guy who maybe I put above him right now might be his own brother. But I think they're both outstanding. But I look at John and what he's been able to do. What fits the best? The Giants certainly are a great fit. I still think that there's the possibility that if Tampa gets a little bit aggressive, maybe they walk away from Todd Bowles, and maybe that happens. I know it's not on the sheets, but it's a possibility, and it's something that has come up. And I like the fact that they've got Baker Mayfield. I like the fact that they've got a very solid offensive line, receivers. They've got a great defense as well. Tampa just needed something more. And this year, I think they could have been a much better team than they were, and it's my old team as well, the Buccaneers. That's where I played. I loved it down there. Great. You just need the right coach, and I think John Harbaugh is the kind of guy that he fits into Tampa. But they still have Bowles right now, so he's not going to be on the Kelce thing. But Miami, not so bad. But do we like the quarterback enough? That's the thing is, does he like the quarterback enough to want to be there, or does he want to be with the Giants and have the quarterback that he would be there? And I think that's probably what he would choose.
That's the deciding factor?
Yeah, I think so. Yep,
Makes
absolutely.
sense. Give yourself the best chances of success. Anybody that he's got the most experience working with or style in terms of picking QB to work with?
Well, I think he's going to really like what the Giants have, because they have some choices, but they had the last year in the first round they took the quarterback from Mississippi. Didn't get a lot of chances. He got some chances to play. They get banged up a little bit. The problem in the NFL is oftentimes when you take a quarterback in the first round, especially very high, that means that you're struggling on the offensive line probably, because you want to have those offensive linemen to protect the quarterback. So, they oftentimes get way too many sacks and that type of thing, when you take the quarterback in front of the O-line. I think if they can get a better offensive line, maybe in free agency, that could make the Giants very, very interesting. And I think that's something that John Harbaugh would be in front of right away, is let's get protection for a guy that we're going to pay a lot of money.
Yeah, fair enough. That's important,
Yep.
right? And so how much longer we got until the Super Bowl, Pete?
Oh, well, we're not that far away, man. It's
Right.
it's always now. It's pushed all the way to early February, but it's going to be fun. And
Always
I think
right around my dad's birthday, late Jan.
Yeah, absolutely. It should be great. I think Seattle's definitely one of those that we're going to keep a very close eye on. On the AFC side, I think it's a lot more open. So that could be pretty interesting as we venture into these playoff games and suddenly we get towards the Super Bowl. The AFC looked strong all year, and it's going to be interesting to see how strong they really are.
Nice. Always good range. Pete Najarian, the only show where we're talking sports betting, sponsored by Buffer Funds, man. One of a kind here. We're all over the place.
Love it, man. Love it, Oliver. You're the man.
All right. You too. Thanks, Pete. Good to see you again. Appreciate it very much. Thanks. Pete Najarian. All right. Market right now, holding on. Pretty quiet day. It is a bit of a slow session with about 19 minutes left. I think the story tomorrow is going to be jobs, as we talked about with Pete there. That's a very important part of it. Looking at where we're at right now from the intraday look on bonds, we're still toying just below 4.2. What's interesting on today's session, if you take a look at the 5-minute candle, look at the way bonds just want to keep coming back. That dotted line I've had for ages, by the way, and that's when I've start to get real conviction, is when something I've drawn holds after a long period of time. So the fact that you've got 4.2 now showing up again, this goes back to February. So that's a pretty good little stretch there. But honestly, if you wanted to, you can see the way we toyed with this for a while back here. Same situation. Look at that, the way it's basically been the anchor, the kind of midpoint of the bond trade for the last, call it 2 years. That tells me that tomorrow is a big deal. We'll talk a little bit more about that, go through my risk radar, check in with Mr. Scott Bauer when we come back. 2-minute break, the Buffer Fund. Be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Renick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Welcome back to Chicago Future of Finance. 15 minutes into the closing bell. We are getting there close. Wanted to run through a few items from yesterday in case you missed it. I had red on the Bitcoin for a long time from a risk radar. It switched to yellow. Want to run through a few of these charts real quick. First one for BTC. Pretty straightforward, I think. Big whole numbers matter, especially in speculative assets, of which Bitcoin still is probably the king, unless you count MicroStrategy. Here's the long-term chart. This is a 2-year chart with a trend line that I've had that was working pretty well for a good bit, seeing the potential for support along the line, and breaking down through that was a big deal. And that's why I had the red light on Bitcoin for a while. But now if you zoom in, you've actually got a pretty decent situation showing up, which is several instances of support going back to mid-November. You've got support at 85,000, call it 1, 2, 3, call it maybe 10 times before now we start to drift off from that. Had a little trouble getting to 95, and in fact, if you actually do kind of a secondary line there, you'll see maybe some resistance at 95. So if you want to be a bit of a faster twitch trader perhaps than waiting for 100K, then maybe 95 will be sort of the first clear for us to start pushing to higher heights. And then MicroStrategy goes right along with that. Yesterday, Scott Bauer and I talked about that trade of long Bitcoin, short Master, probably having run its course for the moment. But I have to say, when you still get specific here, it does look like a downtrend still, because you do have the lower lows in December compared to the lower lows from November. Same thing with this recent push to 170, which is obviously below the previous range. The other items that we talked about throughout today's show is centered around the economic data, which was in the jobs number tomorrow, the jobless claims today that were solid, productivity that looked pretty good, as well as just general prints that have not been disappointing. Mr. Scott Bauer, CEO of Prosper Trading Academy, in the Zoom. Scott, what's up, sir?
How are you? Sorry, I'm not sitting next to you today.
All good. I like you. You've got the virtual version, the AI version behind you.
You got it.
What do you think? Yesterday we talked about BTC kind of and the 100K pivot point, but I don't know. I take a look at this chart again today, Scott, and I'm thinking that maybe 95 has been giving us problems. So if we can punch through there, I don't know. Maybe that'll be actually kind of the first step in the right direction.
You know what? This morning or earlier today, when I saw it trade under 90, right? It traded down to what, 89.4, 89.5. It was a pretty big comeback from there, and I'm not sure why we had that sell off this morning, and it tested it twice. I looking at that chart there, I'd almost be cautious if it does test there again that third time. I'd maybe be cautious of a little downside, but I think there's definite caution there ahead of tomorrow's jobs numbers. The numbers this morning that we saw, the weekly claims, some of the eco data probably stronger than many people had thought, and albeit that's a good thing, but maybe not so much for the likes of crypto or the Nasdaq, which is probably why we're seeing rates ticking up and some of the pressure off some of the Nasdaq stocks today. So I agree with you on that 95, but looking at that chart after hitting there twice today, I'd watch if it gets down there again.
I'm with you. It is as always with me, because I just kind of have this inherent sort of cynicism on it as an asset class. But I try to be adherent to the price. But that was kind of the point of digging into that master chart a little bit too as well, is that when I say yellow light, I mean yellow. I don't mean green.
Yep.
What I mean is now is the opportunity for these technicals to improve. Have they done it so far? I don't know. I look at this chart of master and it still is basically down and to the right. So I think you do need something a little bit more profound sooner than later.
I agree. I wouldn't say that the technicals have really improved. Yesterday we were talking about master and thought maybe with that news coming out that they weren't being removed, or the crypto stocks weren't being removed, that took some pressure off. I don't think that has changed that overall narrative yet, though.
Yeah. So if then we do get real rotation out of this tech stuff, that's kind of been our conversation today, Scott, which is what's your favorite way to play it? The January effect of small caps, a return to the metals trade maybe. If we do get more days like today, Micron, Nvidia, and other recent leaders lower, what excites you as an alternative potentially then?
That's really a tough one, because when you look beyond these leaders and then just look over to some of the consumer staples, say, I'm not so sure. So then you go to the banks with bank earnings coming up, and these things have just, Are they just going to lose its luster because this is, buy ahead of these results? I mean, look
Pretty nice Staples chart there, Scott. I didn't realize.
No, it is. It is. So that's why I'm wondering, is that the place for the breakout? I still think, Oliver, that these big stocks, the Nvidias and even Microsoft to some extent, because Microsoft came down, looking at it right here, it's sitting right at the 200-day moving average. I still think these are buy the dips. Maybe not as robust as they were 3 or 6 months ago, but I think that these stocks are still, on any sort of sell-off, they're worth dipping your toes in. Now, that could change. That could change any moment here. So, I don't think we're going to see a continued rotation out of these. I know everybody's talking today, oh, here we go. We're rotating again, out of tech into other things here. I'm not willing to say yet that it's consumer staples or the financials, which the financials look so good. I don't want to buy into those.
Yeah, well, we talked KRE earlier. Nice little candle there, maybe punching through some resistance.
Yeah, there's no doubt about that. But, look at the Russell. Russell is at all-time highs now, right? So we talked about the January effect and these small caps here. There's a lot of momentum. So that's probably the space, at least in the short run, over the next few weeks, that I would look for.
I like that. Not to get overbought into things that don't really have as clear of a trend yet, right? Because even though we have these nice candles for KRE, for XLP, the chart still favors a micron. The chart still favors even gold or silver. Now, I don't know if I would say it favors mags necessarily, because as a group, they have been very mixed, and the mags ETF hasn't really gone anywhere since fall of last year. So that might be somewhat of a different story there, Scott.
It absolutely could be. There's no question about that. But until I'm still such a firm believer of these pattern trades, and just like we talked about yesterday with gold, and silver's pretty much been the same thing. But that buy the dip has worked, and until it doesn't, I think you got to follow it. And I don't know if it's going to continue to work for a day, a week, a month, 6 months, but until I get burned on it, or until I really see either the technicals or fundamentals change there, I think it's still worth it. And that's really where my focus is. So, truth be told, that Microsoft that I talked about down at the 200-day moving average today, I took a long position there. We'll see how that works. In Microsoft, it's sitting right at the 200-day, right around the 478, 479 area here. It's bounced off of there a few times in the last several months, since kind of mid-November here. Is this going to be the one where it really breaks through? I don't know. But to me, it's worth looking at that and looking at that as an opportunity.
The Microsoft chart, I hadn't realized, had just been basically had that one big earnings from last spring. And then to your point, I just put up the 200-day SMA. I mean, we're sitting right there. This thing has been really good support. So I guess, it cleared this whole period from May to August was a big mover. Then it had that, there's a word for that candle. I'm blanking on it. Where's Rick Duke at when I need him? The red candle where it shoots up, then it comes back down. I don't know, something like that. Some kind of bearish indicator. And then it worked, because then it went nowhere from August to October, pulled back. So I think if you're looking for support in mags names that have been sideways, maybe you start with Microsoft.
I like it a lot. Where's your downside from here? I mean, unless the whole market really turns here, I'm not sure that we get much more of a downside here. Maybe can you get 2-3% over the next couple of weeks? Maybe, but I think that from a reward to risk standpoint, or putting it on the risk radar, I think there's a really good opportunity there.
Yeah, I like that, and this is why I like having good contributors, because I missed that one. It's can't keep track of all of them. You can't
you definitely can't.
So that's really good eyes on Microsoft, the 200-day moving average, because we talked earlier as maybe a different example is Apple. Where Apple is actually, I'll pull up the chart again. It's currently oversold.
It is. RSI is really low. I think it's been down 7 days in a row.
Yep.
I saw a stat earlier today that I want to say the last 5 times this has happened where it's been so oversold and that it's sold off 7 days in a row, it's actually been a very bullish opportunity. It doesn't excite me. It just when I look at that chart and I look at that data, it's okay, great. It doesn't excite me like really looking at that support that we see in Microsoft.
Yeah. To your point, Apple looks like if it's going to go the Microsoft route and revisit the 200 DMA, it's got further to come down because it was just putting in highs in November into December, which was a good thing to look at the time. It was a good indicator for us, that the market was looking pretty firm and was looking pretty strong. But that also means that we need to be aware of it, if it breaks down further. I think when we're talking Apple, Microsoft, it's natural to think about NVIDIA as well. And I have to say that that's been very range bound. But that's one of the best ways for everybody who's saying there was a bubble in NVIDIA, Scott, over the last 2 years. Let's say they were right. Well, guess what? There's 2 ways that you can pop a bubble. You can either do it quickly, short time, big drop in price, or you can do it over a long period of time, no drop in price, and the earnings just normalize. That seems like what has happened for NVIDIA in my mind, which just still makes me want to kind of nibble a little bit and not want to fade it too hard. But it also just, I think, is someone we have to keep on our radar still.
No doubt about it. One other thing I want to point out, and this is specific for tomorrow just because of NFP, and then if there is some news that comes out of the Supreme Court tomorrow, even though the VIX is relatively unchanged today, we're not really seeing volatility move. There's a pretty big put skew in the S&Ps and the Qs for tomorrow, just for tomorrow. You go 5%, 3 to 5% down. There is a pretty big vol skew on the put side.
What does that tell you? People looking for a little bit of a pullback?
Either people looking for a pullback or people trying to protect themselves a little bit and just saying, you know what? I'm not going to necessarily look at the VIX, but I'm going to play it in one of these indices here, and I'll pay up a little for that protection here. But it's very short-lived because it's for tomorrow's expiration. Once we get out to next week, that skew really flattens a lot.
Okay. And the other thing too is I don't blame them. VIX at 16, why not if you think? I would prefer, if I have a view on jobs for tomorrow, I would rather short TLT just because of what we talked about yesterday. The intraday chart on the 10-year, I don't know if you caught it right before I brought you in, but I mean, it just won't let go of 4.2. Nope. It won't let go of 4.2. So I don't know what that tells you. It tells me that if the number comes in surprisingly good, if I'm short bonds, that might be a perfectly fine hedge to stocks tomorrow.
For sure, because if it breaks that 4.2, it's going to go.
I think it will. Will. There's too much strength. As P and I were talking about, there seems to be too much stability in the economy. I mean, too much for bonds to stay down this low if the print comes in good. I'm fine with how much activity there is. I don't want things to slow down. I like shopping at Whole Foods. I don't have to change and go to Aldi permanently.
There you
go. But that's where tomorrow is it. Because why get rid of your stocks if you're worried or, I get the buying the puts thing is fine too, but I kind of sometimes like to try to trade the macros off each other. So maybe short bonds the hedge, or you buy a put because VIX is still pretty cheap.
There's no question. There's many ways that you can hedge right now, and hedging is cheap. Listen, it is cheap. And as a trader, and I'm sure the other traders that you speak with, say the same thing. You buy when you can and not when you have to, right? 100%. You buy before the fire starts. And if the hedge goes away, you lose your money on the hedge, that's completely fine, right? Most people look at that and say, oh, why did I do that? No, that's not the trader's mindset. The trader's mindset is always to have that hedge. It was worth it. It was worth it, and you do it when it's cheap.
Yeah, exactly. Good message ahead of tomorrow's print. Thank you, Scott Bauer. Great way to close out the show.
Thank you, bud.
You got it, CEO. Prosper Trading Academy. Thank you for joining Chicago Future of Finance this week. I will see you next week. Good luck tomorrow in the jobs report. I'm out of here.